Hello and welcome to IR Talks. So while I was preparing for this video on yield curve, my son just happened to pass by and he said, Papa, what are you doing? And I told him about yield curve in all the jargons. But then he said, isn't this a simple line graph? And I was like, bingo. So to keep it simple, yield curve is nothing but a graph capturing yields or interest rates of sovereign or government bonds across different maturities or the tenor as we call it. It's also called the term structure of interest rates. Do remember when I say bonds, I mean bonds of the same credit quality when you're plotting it on a graph. Since it's the government that formulates the economic policies, while the central bank manages the monetary or interest rate policy. The yield curve thus helps to determine how expected or actual changes in policy, along with central bank set interest rates, with other measures, feeds through to the economy. Note, the yield curve is not determined by central bank. It is determined by the market participants' view on interest rates. Of course, basis cues offered by the economy and the central bank itself, like the Fed in the US, ECB in Europe, RBA out here in Australia, and RBI in India. So once the government or any entity borrows money close to the prevailing market rates in the form of bonds, they are then traded in the secondary market. Like equities, they are bought and sold. The yield curve or the graph thus captures the market's expectations of current and future economic activity along with the expected central bank actions. In this scenario, quite intuitively, an investor gets to paid higher as the maturity or the tenor increases. After all, as an investor, you would want to be paid higher for staying invested for a longer term. So this type of a curve forecasts normal economic growth in the years ahead. As the name suggests, this is where longer term rates are lower than short term rates, which means investors are not sure about holding the bonds for a longer term. Thus, an inverted yield curve does not only imply a slowing economy, but in worst case, even a recession. As you have seen in the US, the curve has been inverted for more than a year now. Historically, a recession has followed within 12 to 18 months of the initial yield curve inversion, and an inverted yield curve has preceded each recession since 1950, barring a couple of instances in the late 1960s and 1990s. So will this relationship hold this time? Will US see a recession or a soft landing? We'll have to wait and watch. Do note, by this time, third quarter of this year, US should have been in a recession as per the forecast. And now, some market participants are calling for a recession by sometime middle of next year. But at the same time, Fed has been talking about a soft landing. And as per the data as of now, seems soft landing is quite a possibility. Keep watching the data closely, as inflation in the US seems to be coming off quite sharply, including other parts of the world, like the Eurozone. So while looking at the spread between the long-term and short-term rates, academic studies have focused on the difference between the US 10-year Treasury bonds and the 3-month Treasury bills. Market participants have been more focused on the difference between the 10-year US Treasury bond and the 2-year Treasury bond. In this case, there is hardly any difference between the short-term and the long-term rates. It's more like a flat line, again as the name suggests. And this type of a flat yield curve typically suggests that traders or market participants are worried about the future economic activity. So in terms of opportunities in the current environment, and while I have been talking to some of my acquaintances regarding this, one could look at longer dated US government bonds, specifically US treasuries, or even some good quality investment grade corporate debt, again focusing on longer term, if you want to make those trading gains as they come. One could also look at bond funds, but when it comes to funds, look at the underlying portfolio, where the diversification is, which economies it invests into, what types of bonds it invests into, or lastly an ETF, something like for example a TLT ETF, which has an average duration of 16.5 years within the US Treasury segment. What does that mean? That means if the interest rates, and note again this line graph, the yield curve, if this comes off by 1 percentage point, not the Fed rates, An ETF like TLT should deliver a return of 16.5%. But don't get swayed by these returns. What if the yield curve remains same? What if the yields don't come off that much? So whenever you are investing, please do look at the underlying risk. While there are opportunities, there are always some associated risk to any investments, even if it's a plain vanilla fixed deposits in the current interest rate environment. Which brings me to the point. Do you know why the price of a bond and interest rates are inversely related? That is, when the prices go up, yields come down, or when the yields go higher, prices come down. If you want to know, watch the next video. Thank you and have a good day ahead.